Labadiena, gerbiami verslo partneriai, mėly kolegos, visi, kas prisijungite prie šios ypatingos SEB banko video transliacijos. Pasisveikinu lietuviškai, bet toliau šį renginį vesime anglų kalba, nes jau turime prisijungusius kolegas iš SEB grupės. So I switch now to English, and once again, to all of you participants, I say good morning, dear business partners, dear colleagues, everyone who have joined our live stream on this extremely relevant and important topic in our days. The topic is undoubtedly is extremely relevant and important for every company. After the invasion of Ukraine by Russia, it's clear that the end of cheap energy has come. Moreover, need for long-term energy security became the matter of top importance for majority of EU countries as well as companies. In other words, energy, oil and gas became an extremely sensitive and critical in defining EU strategy going forward. Considering this, we can obviously say that this environment creates uncertainty unseen for decades. This uncertainty results in enormous energy price peaks, soaring to levels above 200 euros per megawatt hours, or actually by times higher than a year ago. The same trends apply to oil and gas, actually. And this is an indisputable challenge for society and corporates to accommodate such price hikes, as well as to mitigate risks related with this huge increase in energy cost, at least to some extent. Considering this, we have approached SEB Group colleagues with invitation to share their view and insights on energy, oil and gas sectors. I do know they are true experts in the field and having very vast and deep experience in analyzing and providing really valuable advice to our dear corporate clients in Nordic countries. And I'm very excited by having the opportunity to introduce our today's key speakers, Bjarne Schildrup and Ole Valbia, with this session to share their insights with us. I will read very briefly their brief CV and what's their experience in the field are. So Bjarne has more than 20 years experience from commodity markets. He has worked with analysis, market modeling, structured deals, as well as trading of commodities for some of the largest commodity trading companies in the world. For several years, he worked with research and forecasting of the CO2 price in the European carbon market, involving European energy politics, fossil fuel and power markets. Since 2008, he has held the position as chief analyst commodities in SEB, covering energy, metals, agricultural products, as well as precious metals. The oil market has been his primary focus over the past 5 years. His colleague, dear Ole, has experience from energy markets and commodities from Norsk Hydro and Rystad Energy companies, in which he was engaged in developing market solutions, focusing on global natural gas, LNG, power, hydrogen, and renewables. Ole has joined SEB in September last year as a commodities analyst. I am sure they have a lot to share with us. First, I stop my intro here, and I would like to give the floor to my colleagues. But before that, I want to stress that we will have Q&A, questions and answer session, immediately after Bjarne's and Ole's presentations. So I want to encourage you to be very proactive and shoot your questions directly, preferably in English, so that I don't lose anything in translating them. And I will sort the most relevant questions, and we will have this 30 minutes Q&A session with them immediately after their presentation is shared. Well, once again, I invite my dear colleagues from SEB Groups to share their insights on this virtual stage, and I say to them, the floor is yours. Welcome.
Thank you very much. It's a great pleasure to hold this energy seminar, and thank you, Ole Valby, for joining me in this. I mean, as was said in the introduction, he joined SEB in September, and he's working for me on the commodity research side. And naturally, coming from Rystad with full focus on natural gas, he has continued this through the autumn and into the spring as well. You know, and it's a radical moves in natural gas prices, obviously. The structure of this presentation, first I'll start out with some broader themes on the cyclicality of energy, oil and gas, move over to focus on oil, and then a bit into future prices for power in Europe. And the second part, Ole will dig into the natural gas market in Europe, which is, of course, also part of the global natural gas market. So I was supposed to change slides. Sorry, didn't quite work as planned. Here we go. So, you know, I think it's important to think about the world of energy and the companies operating in the world of energy. I mean, we often think that markets and companies are very forward-looking, very intelligent, you know, acting ahead of time. But, you know, my experience is that they are rather very reactive. So typical is that the price spikes to, for example, $148 per barrel in 2008. Let's see if I can actually highlight it. So in 2008, we moved to $148 per barrel. In today's value, it's about $190 to $200 per barrel equivalent in terms of the power purchasing power of consumers. I mean, it would be like having $200 today for the consumers. And then the global economy topped out and moved into a deep recession, the global financial crisis, partially helped by the super high oil price, but of course also Lehman Brothers, etc., etc. Consumption collapsed, price collapsed, and then if you are an oil and gas producer, you cut capex deep. And then the next round effect is typically that demand recovers, price moves up, capex eventually starts to pick up, and in the end, supply comes to market. And this, so whenever you have a deep trough, you should expect a high in the following period. And of course, if you look for the period 2011 to 2014, we had an oil price moving between $100 and $120 per barrel in the value of money at that time. Today, that equates to prices moving between $120 and $150 per barrel for today's consumers. And you know, the experience back from that period, 2011 to 2014, was that the global economy actually could manage that kind of price level without crashing, without going into recession. So in that respect, you know, having a period of lost Russian supply, very tight markets, where prices move between 120 to 150, it should be actually feasible for the economy to carry. But if we start to move north of $200, you know, that is when we probably are going to see red alerts for the global economy. That's when you start to hurt and damage the global economy so much that that you could risk having a recession. And I think a lot more and more economists are talking about possible recession. And then if we look at the period of 2020, 2021, I mean, prices on average for oil, coal, and gas were 30, 40, and 50% below normal levels in 2020. And upstream oil and gas capex spending was cut by 40% below what is needed. And we've seen a very careful pickup in capex spending. Of course, during these years here, we lost all this money in terms of capex spending, and it needs to be above normal for several years to follow to counter lost investments in upstream oil and gas. And typically you can think of oil production as a black box where you put money into the one side of the box and out on the other comes oil and gas. It's a conversion of money into oil and gas, and it is indeed a time lag. And typically time lag, you're talking about about 5 years lag from you start capex spending and until production starts to come rolling. And this is the concern of the global oil market and gas market as well, that we've had this incredible trough in capex spending these years, and that this will create a wave of deficit in the following 5 years. So these data here on upstream oil and gas is from Rystad Energy, and the green data here are equal to the lilac here. I'm sorry for the color confusion on this. But what I'm created here on this green line going up is the 5-year average capex spending with the 5-year lag, basically saying that, from a very top-down analysis, you should expect to see something of the effect on the production side deterministically declining for the next 5 years. If you say that the 5-year average with a 5-year lag is typically what you should expect of production. So, I mean, think of the peak capex spending in 2014. When do you actually get the consequence of that production to materialize? I mean, typically 5 years later in 2019. So this is the sort of the important time lag, and this creates huge waves historically, typically in upstream oil and gas, as well as commodity markets in general have the same kind of dynamics. So, I mean, not everyone agrees that we necessarily will have to have 5 years with high prices. And if we look at Rystad Energy on the right-hand side, it's their forecast back from January before the invasion of Ukraine. They basically said that now we're moving into surplus and price is going to average like $50 in 2023. So basically saying, yes, we understand the top-down argumentation, but the conclusion is wrong. We're not going to run a deficit. So I think we've never had such a huge difference in opinions versus the next 5 years of oil prices as we have now, with Citibank, Edmores, Macquarie, Rystad basically saying that, well, we'll run into surplus, demand is not going to be all that strongly growing, and price is going to go right down. And then you have Goldman Sachs higher for longer, $105 next year, and then just charging on around the $100 per barrel benchmark. So it's really huge difference. I think what is clear is that we have an extremely tight situation right now. And we're not going to get any immediate relief in terms of that tightness before we get to the end of the year, with very high risk for prices into second quarter and potentially third quarter. And of course, what has helped the oil market the latest years is, of course, US shale oil, which you can see on the left-hand side. And shale oil production is indeed growing rapidly, about 1 million barrels per day per year. But you can see that the angle and growth rate now is indeed slower than it was during 17, 18, and 19. I mean, prior to COVID-19, we had a growth rate of US shale of 1.5 to 2 million barrels per day per year. And now we're growing at more like 1 million barrels per day. And they are indeed drilling too little, and they are drawing down and eroding wells that they have drilled before, but not completed. So they need to add more rigs, at least 150 more oil rigs, of which they add typically like 4 or 5 rigs per week these days. And then we of course get to Russia. I mean, most of you probably know this very well. I mean, Russia is the absolute biggest exporter of oil and oil products in the world, actually bigger than Saudi Arabia. Might be right now a bit different, but when you look at 2019 data, you can see that they exported something like 8.3 million barrels per day of crude and products. And typically the assumption is that assessment is that they export something like 5 million barrels per day of crude and about 2.7 million barrels per day of products these days. So they are a huge exporter of oil products and not just crude. And most of it is flowing to Western Europe, and a little bit is flowing through pipes and some train transportation to Asia. But that is more like 1.6 to 2 million barrels in total flowing to the east. And of course, Russia, in addition to this, Russia is also exporting around 4 million barrels per day of oil equivalents in terms of natural gas. So in total, exporting more than 12 million barrels per day of oil and gas and products. I mean, this is the elephant in the energy world, bigger than Saudi Arabia, and when we also include natural gas especially, but we can also add a lot of coal exports. So when we then get all the sanctions hitting Russia due to the invasion of Ukraine, naturally we have incredible moves in the global energy markets. And if we look back to intraday price movements for Brent crude back to 1988, look at the 10 biggest moves. Then 6 of those 10 biggest moves are in March this year. I mean, that is a real reflection of how huge Russia is. And I think a lot of people nowadays talk about how energy markets in general, or commodity markets in general, and oil markets and natural gas markets specifically, basically are broken, both on the financial side, but also on the physical side, because it is getting so expensive for margin requirements, for shipping rate, for insurance, etc., that even physical shippers are getting problems of hedging their cargoes and carrying the risk through the journey of that transportation. I think what is important is, of course, to reflect on this energy marriage which Western Europe entered into with Russia, basically saying it should be a good thing to have a cooperation on energy where Western Europe consumes Russian energy and where Russia gets money from Western Europe. It should be a great foundation for common understanding, for development of both cultural and economic relationship and understanding over time. This was the energy marriage expected and thought to be lasting for many decades more, with Russia and Western Europe walking hand in hand into the future, sharing money and energy in this way. I mean, what is now very, very clear is that the day after the invasion, we saw Germany turn 180 degrees from continuously defending the energy marriage with Russia, defending, consuming and importing huge amount of natural gas, promoting the Nord Stream 2 pipeline. You know, the day after invasion, Germany turned 180 degrees and say, this is the end of the marriage. We are going to end our energy imports. Of course, like in most marriage, it's hard to move out of and apart the same day, and it takes time to wind down this energy marriage and replace it with something else. But I think Europe is now working extremely hard to move away from Russian energy, both oil and natural gas, and Ole is going to dig into more of that. And so far, you know, the sanctions, you know, Europe is finding it difficult to sanction so far Russian energy, while the private market is actually performing explicit sanctions and buyer strikes. And if we just think about oil and oil products flowing out through the Bosporus Strait here, it equates to about 2.4 million barrels per day. And today we see a huge problem getting ships to move into the Black Sea due to the war situation, extremely high insurance costs and freight costs. So that alone equates to 2.5 million barrels almost of halted supplies. So far, the statement is that crude oil is still flowing because it was contracted before the invasion, while actual products, you see that they are starting to move to a trickle of normal flows with significant reductions or closures of Russian refineries in the southern part of Russia. So I think this is where we feel the biggest pain in the energy market in Europe right now, lack of oil products normally flowing from Russia. Of course, we see a lot of activity on the political side from the US to try to propel the so-called JCPOA Iranian nuclear deal back in operation, potentially leading to an increase of production from current 3.1 to back towards 4.7, 4.8. With a comparable increase in exports from that, as well as we see political efforts to get Venezuela oil production back online as well. So, I mean, this wouldn't necessarily mean more oil into the market in net terms. It would be an opportunity if the US could get these volumes back online. We would likely see comparable explicit sanctions directed towards Russia from the Western world. So net, the market wouldn't be more in surplus of oil, but it would be harder for Russia. I think most expectations in terms of Russian oil exports into April, we see a lot of offered cargoes, but prices are at a discount of typically $30 per barrel in reflection of buyer strikes. And I think in general, expectations by the major oil companies, we see, or oil trading companies like Gunvor, Mercuria, Trafigura, etc., they say that we're going to lose a minimum of 2 million barrels per day of Russian crude and products, but probably as high as, or maybe as high as 3 million barrels per day, with a consensus of a loss of 2.5 million barrels per day of crude and products, of which 1.5 million barrels is crude and 1 million barrels is products. So just a little bit on oil inventories. Here, the US inventories is a good reflection of the global balance, and we see that inventories continues lower and lower. And also we can see that the market is pricing in very high prices with expectations of further inventory declines, basically. So I think the market is expecting the US inventories to contract another 200 million barrels and move towards like 950 million barrels of commercial inventories in the US in terms of crude and products. I think that is very much what the market is expecting right now. If we look at US product inventories, we can see that US gasoline inventories are still quite healthy, while middle distillate inventories are very low. And so this is where we see the greatest pain in the European market and the global market. It's the middle distillate price. And here we look at the 10 ppm diesel prices, where the backwardation is spiking to unseen levels, basically reflecting as an incredible tightness in diesel. We see that diesel prices in Europe recently moved to $168 per barrel, almost as high as the diesel price in nominal terms back in 2008. So we have an ultra tight diesel market right now. Just very quickly, the energy complex is huge. And of course, it matters what is the price of oil versus gas versus coal. And with natural gas prices as high as $200 per barrel of oil equivalents, oil is, of course, very cheap at 111, and all consumers who can, they will switch to oil products in refineries, in petrochemicals, in heating, in factories. And of course, coal prices are extremely cheap per energy unit. So what we are going to see is increased power burn, both in Europe and in Asia, where we have also very high natural gas prices. Looking forward on power prices, they are of course fluctuating all the time. In the longer term, the CO2 price is going to lead to a new power price in Europe, typically around 70 to 100 euro per megawatt hour due to the CO2 price, even when coal and gas prices move back to normal. So I think the longer term power price in Europe is going to be somewhere around 80 euro per megawatt hour rather than the normal 40, solely due to the CO2 price. And we can see that the longer term, we see that the German power market typically trades down towards that level as well. Very quickly, we think that we're going to have a solar boom. We have typically the normal global power consumption growth equates to about 600 terawatt hours per year. That is about 1.5 Scandinavia increase in consumption of electricity per year. By end of 2022, according to Bloomberg New Energy Finance, the installation capacity of global solar is expected to be close to 500 terawatt hours alone. So that basically means that the manufacturing of new solar panels is becoming so huge on a global level that you almost can cover all of global power consumption growth, basically meaning that there will be little and very limited amount of growth left for coal and gas in the global power sector, because it's all going to be taken by solar energy. And of course, you can add wind power, nuclear, hydro, and bio as well. So, of course, we have energy consumption growth in many parts of the global economy, not just power, but at least from the power side, you shouldn't expect to see increasing consumption of oil, coal, and gas beyond 2023-24, basically because the capacity of solar and renewable per year installation is becoming so incredibly huge. And of course, also because the cost of solar here is the cost of solar in Europe in 2021 at 33 36 euro per megawatt hour, and then the new price in Europe Power will be 80. So it's going to be super profitable to install solar. I think we're going to have a solar boom in the coming years. So I'll just skip this one and move right over to the natural gas. And it's, of course, a market a lot of people don't know so much about. It's more complex, it's more hidden, it's more off the screen, so to speak. While most people have heard about the oil market, not so many people know about the natural gas market. And I'm really happy to have Ole here, who's been doing nothing else for several years, and especially the latest months since he joined in September. So Ole,
yeah, well,
it's all yours.
Thank you so much. So we will look more into the natural gas market, especially focusing on European market. We have chosen to illustrate this image on the front page here. This is the image of the Brotherhood pipeline, which goes through Ukraine and into Slovakia before the gas is distributed to the Western Europe. Just to get a sense of this pipeline, you see that you can understand the vulnerability of this pipeline just by looking at the picture. So we have been talking a lot, me and Bjarne, and like, okay, it's quite strange that this pipeline hasn't been blown up already. That is actually up and running at close to full capacity, even though looking like this. So what we have been witnessing is we have been through a really strange year. First of all, after the summertime, we saw there was a immense winter risk ahead of the winter, where all large natural gas consumers were hoarding as much natural gas as possible. Then we were rolling off this sort of winter risk at the end of December, early January, because the winter was less cold and more favorable than what we thought. But then we were rolling into what we call this invasion risk. So then the natural gas market in the US was pricing in a severe risk of an invasion of Ukraine. Lastly, since 24th of February, we have seen that it's been a full-grown war in Ukraine, and now we see a proper war premium on the natural gas price. So looking at this first slide, on the left-hand side, we're chosen to illustrate the international gas prices dating back to February 2020 and then up until now, March 2022. So what we see is that we have the natural gas price in the US, the Henry Hub in green, followed by the lilac one, that's the TTF, aka the European benchmark price. And then on top, the blue one, we have the Japan-Korea marker, which is more or less the spot natural gas price for LNG on the global market. What we see is that we are coming from quite low levels in let's see here.
Først se hvor det og så må du trykke på denne siden.
All right, great, thank you. So what we see is that we are coming from quite low levels during the COVID-19 first wave in early March, April 2020, and the prices have been growing since then. You can see that unusual spike on the left-hand side, comparing the lilac with the blue. And the reason that the LNG price in Korea and Japan and China was higher than in Europe, that's because we usually in Europe, we have a lot of inventories. So we don't have to go into like this sort of volume war against the global LNG market. But that has been, of course, changed this year. Since then, we've seen a insane and really volatile market. Now, currently, we're pricing at around 106 euros per megawatt hour. And prices have been fluctuating around this level since this quite substantial spike we saw in 2 weeks ago, where the price spiked to 340 euros per megawatt hours at intraday high. At the right-hand side, we see the front-month German power price versus the European natural gas price. So basically, why we choose to image this to you guys is that because the natural gas is the marginal cost of power in Europe. And then you understand the seriousness of the consequence of a skyrocketing natural gas price, basically also dragging the power price as well. So on the right hand side here, you see that the average historical average power price in Germany is around 40 euros per megawatt hours. But now we see that given the really high natural gas prices and also the forward curve for the natural gas prices, we see that next year, hence the calendar year of 2023 is now trading at 180 euros per megawatt hour, which is of course really high. Anything to add there, Bjørnar?
Yeah, I think, if you look at the left-hand graph here, you can see this is a very strong relationship between the European TTF price in lilac and the Japanese LNG price in light blue. And the fact is that this relationship has been there for at least 5 years. So, and this is the reason for that is because Europe is importing a significant share of LNG to its global consumption to such a degree that European prices are indeed set by the global LNG price, and they have been doing so for the past 5 years, but no one have really noticed because prices in the global LNG price market have been low.
Definitely.
So I mean, it hasn't really taken any attention of the market, but that is going to be the fact also in the years to come, and even more so. European nat gas prices are going to be equal to the global LNG prices as they have been for the past 5 years. And I think in terms of the right-hand graph here, I mean, it's mind-blowing how expensive it is. I mean, the price of power is like 5 times the normal levels. We're not talking increase of cost of power of 30%, 40%, or 100%. We're talking 500% versus normal. This is a massive burden for the European economy, both in terms of natural gas cost and thus also power cost. And I think normally Europe, the EU 28, including UK, typically use like 350 billion dollars per year in oil and gas. I mean, this year, these 28 countries are probably going to pay $1 trillion for that energy. I mean, it's going to hurt.
Definitely. And also really good point on the LNG, because now, of course, we will get back to this in a few slides, but the natural gas market in Europe is now pricing more and more on LNG. So LNG will be a more important driver for the price. And just as a backdrop, LNG is, of course, a more expensive product than piped natural gas from, for example, Russia. So we will go through a bit of the status now, and we will also look more into from the winter risk to the war premium, which we're experiencing. And then we will close up with a 2022 outlook. First, we are presenting here the EU 28 natural gas balance. This balance on the left-hand side is the balance for the year of 2019. So what we see here is that the consumption in Europe, it's around 5,212 terawatt hours per year. And for reference, Russia delivers, and this is at a normal year, so it's important to have that in mind. Russia delivers around 37% of the total EU consumption. And this, if you look at the EU imports, then comparing Russia with Norway, LNG, etc., you will see that they account for a massive 44% of the EU imports. On the far left corner, you see the domestic production in EU 28. And why we're getting more and more reliant on natural gas imports into the European market is, of course, largely driven by this domestic natural gas supply, which on the right-hand side are plummeting. We see a quite steep decrease in the production in Europe, and this is largely as a consequence of the phasing out the supply from the Groningen gas field in the Netherlands, which is also the largest natural gas field in Europe. We see that the Groningen gas field peaked at around 2013, delivering close to 600 terawatt hours. But now we see that the decline on the overall profile are likely to decrease by around 23% from 2019. Going forward from 2019, which is more or less a year of normality, and up to 2035, we have a negative CAGR of 3%. And we are likely to see a EU 28 supply further out in the curve at around 700 terawatt hours. So this means why we are looking into this quite detailed. It of course means that we will be more reliant on imports, more reliant on Norway, more reliant on LNG, and it was a big plan to be more reliant on Russia. But now that picture has of course totally changed. Yeah, Bjørnar.
I think, important point here, several important points. One is, of course, that we have the steepest decline in European production behind us.
Yeah.
So going forward, the yearly decline is going to be much, much smaller. And that is, of course, a very good thing. And it's going to help a lot. But it's mind-blowing how big Russian imports. This is from 2019. We're talking 37% of total EU consumption was covered by Russian natural gas in 2019, and it's a huge amount. But now it's going to change big time.
Yeah, definitely. And also worth mentioning that on the domestic supply, of course, it's not including Norway. So this is EU 28. So this is the production, natural gas production at the continent. So Norway, of course, also gain more importance going forward. And we also see, I will get a bit back to that later as well, but we see this is a base case for the supply profile, and we could see some less decline due to the secure supply issue.
And I think the last thing to comment here is looking at the LNG imports in 2019 at 844 terawatt hours. 16% of total consumption was covered by LNG. And this is why the LNG price has been setting the price of natural gas in Europe for 5 years running already.
Great point. So next up is this European natural gas inventories. It's really difficult to talk about natural gas in Europe, especially in Europe, not mentioning the inventory levels. So I was mentioning this winter risk we have been witnessing after the summertime. Of course, it's not that much relevant anymore. We are more at comfortable natural gas inventories than what we were, but it's important to have in mind considering the increased demand for natural gas, and then also the quite steep decline in domestic supply, which I showed you on the other slide, and also the Russian volumes, which has been quite choked lately. Then we see the seriousness of the situation, why inventory levels now being at 5-year low. And it of course adds to the tight market, because we have all this series of all these factors playing together and making the market even tighter. So it's not, but you can also, we had a chat about this as well, Bjørn. This year was a dream scenario for us, right?
Yeah, look at inventories at the end of 2021, the light blue line ending at 602.5 terawatt hours. Well below the mean max range from 2015 to 2020. And we did a lot of research on winter weather risk in the late autumn to address this. What if the winter is cold? And what we found out was that maybe every 5 years is a really cold winter. And with this kind of start of the winter before Q1, at very low inventories, the risk was incredibly high that we wouldn't be able to carry through the winter with the natural gas inventories we had. And also typically what we looked at was that if you have a very cold first quarter in Europe, you often also have a cold first quarter in the US and in Russia and in Asia, right? So it's not only Europe getting into trouble with a cold Q1, but the exporters of natural gas, being Russia and the US, would then also export less because they would need more themselves, and Asia would import more. we were really lucky with the weather in this year.
Yeah.
Very warm,
Definitely.
lots of wind,
Mm.
no problems.
Mm.
So that is why inventories didn't really crash down to historic lows, but are bottoming out right now in March, at comfortable levels. But look, I mean, we're still below the path of 2021.
Yeah, definitely. And this will, of course, this is of course important when we're going to talk a bit later on also regarding the forward natural gas price as well. We're filling up the inventories, and it's also, of course, there's still severe risk that next winter will be quite cold.
Exactly, and right now the market is thinking, well, it's a long time to next winter, right? So the market is kind of comfy about the next winter. We have lots of time to fill it up. LNG ports are running red hot, so we'll make this. But of course, this is at the end, this is up to Russia to decide the path of European natural gas inventories. Is in the hands to be controlled by Russia. I mean, if they hold back, I mean, they can look at the inventories levels of natural gas in Europe all the time and make sure, I'm quite sure that Russia is going to make sure that the end of year natural gas inventories in Europe are at very uncomfortable levels with a lot of winter risk. When we get to Q4 this year, the market is most likely we're going to have low inventories. It's going to be gained by Russia, I think, and the nervousness for a Q1 2023 possible really cold weather. That is how I think it's going to play out.
Yeah, no, that's a really good point. So next up, we will look a bit into this from this winter risk to this war premium as we are experiencing now. We will start up with a overview of the Russian natural gas pipeline system. On the right hand side, you see the Russian natural gas pipeline network. So on top, we see the Nord Stream 2 pipeline, which is of course not up and running. That has been fully closed down. The company owns it, is bankrupt, and we sort of believe that is likely to remain dead in the water, at least for a very long time. And then under that, you have Nord Stream 1. Nord Stream 1 is supplying more or less only long-term contract to the German market. This goes through the Baltic Sea. And then under that, going south, we have the Yamal pipeline, which goes through Belarus, through Poland, and then into Germany. And then further south again, we have the Brotherhood pipeline network, which I also displayed on the first slide. So what we see is that we get a lot of questions and a lot of questions around this. Okay, if Russia decides to not export any natural gas through these pipelines to Europe, are these flows or volumes able to be rerouted other places? Can they go into the Asian market, for example? Can they be exported more LNG, etc., etc.? So on the left-hand side, we made a Russian net gas pipeline export capacity overview. So from left to right, you see that the current capacity supplying, this is the capacity. So this will be if the pipeline are running on 100% utilization, Russia are able to deliver around 370 terawatt hours per year of natural gas to China. If you compare that to the Western European market at 1,775 terawatt hours per year, you see that this is only peanuts. So the rerouting capacity and capabilities for Gazprom in Russia is really limited. And we are seeing that, of course, there have been talks about building a Power of Siberia expansion project that was likely to start up at the end of this year. We haven't seen any news about it. It's probably scrapped. But we also have the Power of Siberia 2, the Altai natural gas pipeline, coming online in 2030. That's more likely to come online now because of the circumstances we're in. But if we're talking more short term, the rerouting capabilities to Asia is more or less peanuts compared to the Western European market. I also highlighted here on the right-hand side, you see Ukraine there and the Brotherhood pipeline network. The natural gas flowing from Gazprom or from Russia into Western Europe, more or less 33% of these flows are flowing through Ukraine. And that's also why we see higher prices. We've seen prices spiking when there is bombing close to this vital infrastructure, etc. So it's also what me and Bjarne had discussed this a lot, and it's also a quite serious risk that this pipeline network will be blown up in the war. Right, Bjarne?
Yeah, I think, I mean, it's almost a mystery that the Brotherhood pipeline through Ukraine hasn't been blown up already or damaged already. And I think with the ongoing war just going on and on for weeks and months, I think that the risk is very, very high that the Brotherhood pipeline through Ukraine will indeed be damaged at some point, and that we're going to lose this flow of natural gas to Europe. And of course, in the short term, it's very little Russia can do to reroute this natural gas. And I think, right now, Russia is making a lot of money still, even if they export only at 2/3 of normal volumes. I mean, Europe, in terms of oil equivalents, Europe has lost about 1 million barrels per day of oil equivalents in terms of natural gas. It's a lot of energy that is lost in the supply to Europe, partially compensated by higher LNG imports. But of course, this reduced volume is compensated in terms of Russia by higher prices. So in terms of income to Russia, they are maybe not suffering at all, even if they export only 66% of normal, because prices are much higher. But of course, I mean, in the medium term, we know that the Western Europe is moving away from Russian energy, and I'm quite definitely certain that Nord Stream 2 will never come online. And over time, it's going to be very little natural gas flowing to Western Europe, and you're going to get back to that.
Yeah, and it's also good points there. It's also fair to mention that you see those two circles with the LNG there on the map on the right-hand side. This is two LNG import terminals planned by the Germans, and this is Wilhelmshaven FSRU in south, and then you have Brunsbüttel LNG onshore terminal more in the north there. And these two terminals were actually planned scrapped. They were scrapped in January 2021, but they soon came up on the drawing board again as soon as the invasion started 2-3 weeks ago, 1 week after the invasion or so. So we see that Germans are able to shift their mindset quite rapidly to find the alternative comparing that to Russia. But it's really, really important to understand the scale of this. Those two LNG import terminals alone in Germany, they will be able to import around 170 terawatt hours per year. If you compare that to the flows we have seen on Nord Stream 1 lately, or historically as well, that's Nord Stream 1 are supplying around 540 terawatt hours per year. So 170 versus 540, you get the picture here. And it's also those two LNG import terminals are likely to not get online before late 2024. Or Wilhelmshaven is an FSRU that's likely to come maybe mid next year. Maybe. But of course, we'll see. Their desperate times call for desperate measures. On this next slide, we have also chosen to show you the status of these three really important pipeline networks. So on the right-hand side, you see the Nord Stream 1, that's in green. And then you have the Yamal in lilac, and then you have the Brotherhood in blue. So we're coming from, I was talking about this winter risk, we had low inventories, we had less supply from Russia, and now you sort of get the idea. If you look at the overall total terawatt hours per day on top, the yellow one, and what you see is that this flows from Russia has been steadily declining throughout the last 2 years, and now we're at as Bjarne mentioned, around 66% of where we used to be, and this is more or less because Gazprom and Russia has decided to halt the entire spot volumes into the Western European market, and are now delivering only on long-term contracts, which is fair because you want to build a pipeline with long-term contracts, right?
Yeah, I mean, it's a bit of gaming from Russia's side, besides all the issues with Ukraine. I mean, Russia really want to have firm, long contracts with Western Europe as a known offtake of Russian nat gas for the next 10 to 20 to 30 years, to know that they can actually export it to Europe.
Yeah.
While Europe is saying, you know, we'll just go for the spot contracts, we're happy with that. And then Russia is basically saying, fine, if you want to go with the spot contracts, we're not going to promise you anything in terms of deliveries. And this is in a way also a part of an effort by Russia to try to force Western Europe into longer term contracts, which of course now is totally out of the question and it's not going to happen. But that was a bit of the part of the gaming. But I think, you know, the graph on the right hand side is kind of interesting as well in terms of Russian capacities to export. So what do you think about that graph, Ole?
Yeah, it's a bit back to the cyclicality Bjarne was talking about in the beginning, you know. So this is of course the base case, but Russia, as every other large supplier of natural gas or oil or anything for that matter, have of course also been hit by this COVID cyclicality, the lower capex spending, etc., etc.
The very low prices naturally sort of hurt and led Russia also, as well as everyone else, to reduce capex spending in the COVID cycle. So I think, you know, looking at nat gas exports in 2020 and 21, you know, they fell sharply versus previous years and are now expecting to rise sharply. That remains to be seen if they can, though, due to sort of buyer strike in Western Europe. But still, you know, it is a bit a reflection of the cyclicality as well. So it's not just gaming from Russian side. It's also a result of the cyclicality in low prices, low capex spending and declining production capacity. And now they need to revive that. But I think, you know, in the current environment, there is indeed going to be reduced capex spending in Russian oil, upstream oil and gas going forward due to the current circumstances with the war in Ukraine. So I think as a natural consequence, we're going to have lower oil and gas production 1 year from now than we otherwise would have had, even if prices are high.
Yeah. Right, so that takes us over to the 2022 outlook. More close this up, and then just to get a sense before we dive into what we're seeing through this year, we just wanted to compare that normal balance we started off with the ongoing war on the right-hand side. So what you see now on the right-hand side, we see that the domestic production in EU, okay, first of all, the consumption in EU has of course decreased. And this is natural because we got some demand destruction due to really high prices. We got some offset consumption by increased coal consumption. And what we see, so we are now at around 5,000 terawatt-hours of consumption in year 28. And on the right hand side, we see that the production has has decreased slightly, and that was back to what I mentioned in the beginning with that the supply profile declining. And then now we also see that what we're mentioning now a few slides back, that the Russia only delivers those long-term contracts, the spot volumes is disappearing, so that's around 1,200. But we have seen a quite surprising or really good increase and at the flows coming from Norway, increasing around 10% compared to the normal levels. But the large or important factor, which also we will discuss a bit in the next slide, is the increased flows from LNG imports, increasing by around 36%. And that's important to have in mind, because if you look at this slide here, we have tried to equate more or less where we are heading in EU 28. So this is the natural gas balance for the end of this year, and this includes the sort of like European Commission wish list. Because what's happening is that the European Commission, they went out and they mentioned that they want to reduce the reliance on Russian natural gas by around 80% compared to the normal year at the end of this year. So this is a really bold statement. Have in mind, this is at the end of 2022. This is only 9 months around the corner. So that'll be really interesting to follow. But what we see is that the consumption in EU28 are likely to be decreased somewhat, and that's, of course, again, more demand destruction, higher prices for longer, more demand destruction. Then we also get more offset consumption of natural gas by coal, and also we see a more increased build of renewables are likely to come online, and also maybe more also favorable weather situation this year. The European domestic production, we saw that the reduced growing and decline rate are likely to be reduced. There has been a democratic voting in the Netherlands, voting for more supply from Groningen, even though we see the real risk of earthquakes in the area. But the people want the risk of earthquakes is less than the risk of want to help out get more Russian volumes. We also so basically security of supply has been like the main priority, and then you can risk earthquakes, etc. The Russian supply, that will equate to around 80%. That means around 400 terawatt hours. That will mean 9% of the total EU consumption. We see that of course will be a really nasty divorce, which Bjarne was talking about, and we also see that there is probably no way back. And the risk here is that if we are purchasing these low volumes at the end of the year, are Gazprom or Russia likely to give us anything at all? That's of course the big question here. Norwegian supply likely to remain stable from what we see now. We can't adjust that anymore further. But bear in mind here the LNG. Really important is the LNG imports, which are likely to increase by around 31%. And this means that we will have a utilization on the existing LNG import terminals at around 90% versus the historical 57%.
Yeah, I think, looking at the big increase in LNG imports, I mean, we're talking an increase of like 600 terawatt hours per year of added imports to Western Europe from the global market. And that basically means that Western Europe is going to vacuum clean the global marketplace for LNG this year. But not only this year, also the next and the year after and the year after, because we're not going to move back to increase imports of natural gas from Russia. Rather, Western Europe is going to go all in to move that 404 terawatt hours run rate, yearly run rate end of this year, down to zero as quickly as possible. And that basically means that Europe is going to pressure prices in the global market, take volumes that normally would go to Asia and take them to Europe instead. And that basically forces Asia to burn more coal instead, but also to install yet more renewable energy. And I think that is one part we haven't included in this. You have the renewable offset, 200 terawatt hours. So I mean, we are installing quite a lot of renewable energy in Western Europe on a yearly basis. So 100 terawatt hours worth of renewable energy installation actually equates to 200 terawatt hours worth of natural gas, because you lose 50% typically when you convert natural gas to power. But this picture basically points to very strong prices going forward, and that is basically our final slide.
Yeah. No, really good point there. And so here on the last slide, we have chosen to illustrate the TTF in Europe per megawatt hour. So what you see that we were discussing this a bit in the beginning, that the prices are likely now to sustain quite high throughout the entire summer months. And that's because we need to fill up these storages quite fast, right?
Yeah, and also, I mean, the whole situation extremely tense, right? I mean, we have this aggressive transition away from Russian natural gas imports, moving to only 20% of normal run rate levels by the end of the year. And also, of course, I mean, the situation between Russia and Western Europe and the US are extremely bad level and very tense, and Russia is going to game it. We're not going to have a situation that is going to be home free and easy and when we run into next winter. So, I mean, the price of natural gas we're talking about here, 100 euro per megawatt hour. I mean, that equates to like $200 per barrel of oil equivalents.
Yeah.
And in natural gas and power terms, we're talking 5 times normal. And you know what we've seen earlier when natural gas prices spiked both before Christmas but also after the invasion was that we moved to, I mean, recently intraday we moved to $600 per barrel of oil equivalent or 300 euro per megawatt hour for natural gas. And why didn't we stay there? Because the economy cannot carry that kind of price, right? And I think the learning is that in the short term, prices can move however high.
Yeah.
But in the medium term, they always have to come back down to a level where consumers actually can afford it. And I think that is why we have settled around $200 per barrel of oil equivalent, or about 100 euro per megawatt hour for natural gas. This is probably, you know, the breaking point for what the European economy is able to carry of such energy costs. So even if we now see that the Brotherhood pipeline blows up, then yes, we would see a spike in natural gas prices going back up to 200 euro per megawatt hour. But again, I think it would be very hard to stay there because it would destroy demand and basically drive the economy into recession. So, you know, I think that is why we sort of move and stabilize around these price levels rather than moving it higher. And then, of course, going to next year, beyond the next winter, market hopes that things starts to sort of normalize a bit. And we are just trading 3 times normal price levels for natural gas. And then the year after, 2 times normal. And then in 2025, 1.5 times normal, roughly. So, and you know, it's so volatile, it's so crazy, and it's so hard to just pinpoint the correct price naturally because there are so many uncertainties. But I think, you know, are these prices fair? I mean, they don't sound ridiculous. They are very high, but, you know, maybe that is a fair assessment, just sort of the market price saying what do you think about the price?
No, I agree. And I also think it's really important to have in mind that you see that on the right-hand side there, you see that the historical average has been fluctuating around 20 euros per megawatt hours. And going forward, you know, going out of COVID, going out of war and everything, like in the long term, I think we will see more natural gas prices will be higher. You know, it will be a higher price. And that's, of course, back to that we're now pricing the marginal supply from LNG, right?
Yeah,
and
we have done that for the last 5 years.
Yeah.
But the difference now is that we are aggressively buying whatever we can find in the global marketplace.
Yeah.
You know, right now, price doesn't really matter all that much.
That's also a really good point. And that also means that the Northeast Asian market needs to attract less LNG. They have to burn more coal, etc. So this is, of course, a really complex game.
So Asia basically says, all right, if you're willing to pay that price, fine, it's yours. Right. I mean, that is how high we have to push the price.
Yeah.
But I think we're going to have a struggle for LNG into next winter as well. But, you know, looking at next year beyond Q1, we have like 60 euro per megawatt hours. That is about $120 per barrel of oil equivalents. And we know that kind of price, that kind of cost is typically something that the economy probably can handle, though, even though it's like 3 times as expensive as normal. So, I mean, forward prices doesn't look all that ridiculous given that Europe is basically moving away from the greatest source of supply of energy it has and moving right into the global marketplace and vacuum cleaning it for whatever they can get.
And with that note, that's a good closure.
Yeah, so finally, we're getting to Q&A. So it's only 20 minutes for Q&A, but I think we can close our presentation.
Good. Thank you, dear Bjarne and Ole. I think I was really amazed and very interesting listening to what complex things you explained in a really simple manner and really deep insights what you shared with us. Thank you for that. And yes, we do have a number of questions from our dear listeners. And I will try to shoot them, even though we will have approximately 20-25 minutes for this session now. Okay, I start with the first one, which asks, what are your thoughts on the EU's recently announced plan to break the dependence on Russian gas? Is it even possible to achieve without nuclear energy?
Well, I mean, sort of we've gone into details, and Ole went through that, and I think what is clear
I have
is,
some issues, I see.
You cannot hear me?
Did you manage to hear my question?
Yeah.
Sorry,
Yes,
I think I have some technical issues. Okay.
Can you hear me?
Yes.
Yeah. All right.
Perfect.
So I think, it's very clear that this is a more or less final decision by Western Europe to move away from Russian energy as quickly as possible. I mean, this energy marriage is ending. And we are moving into a new Cold War too, between Russia and Western Europe. And relationships is cut across all different sectors, not just energy, but we see all different companies are withdrawing from Russia, and we're going to have a lot of brain drain of all people with resources and capacities are most likely also going to leave Russia. It's a very high probability for that. But most likely Western Europe is moving into defense modus, and security of supply modus, and basically drawing down the Iron Curtain. Both sides are doing that, and I think it's going to be 20 years, 30 years of a new Cold War, and before Western Europe can negotiate with Russia again, I mean, probably would have to be a different leader in Russia for that to happen. Not necessarily a different type of leader, but probably a different leader before relationships potentially could improve again, I think. So of course, it's a big question, how quickly could it be done? And for now, I mean, latest years, it was all about the environment, and you didn't have to care about price because price of coal and natural gas and oil was really low. It was a surplus in the market. So no concern about price, all concern about environment, and really no care for security of supply either, right? The biggest natural gas storage facility in Europe, in UK, was closed in 2017. Who cared for like storage and safety? It's like, just buy it in the spot market, no worry. And now it's they don't worry about the environment. Now it's all about security of supply. Now it's all about getting the job done to move away from Russian energy imports. And of course, it's impossible to do it overnight. But I'm kind of surprised about the extreme aggressiveness of aiming for a 20% run rate at the end of this year. Whether it's possible or not, it's hard to say. But I mean, they have specific plans of how to do it. And of course, a boom in LNG imports is one, but now, you don't care about the environment for the nearest years. We'll take the environment later. Now you can burn as much coal, and you can burn old car tires, garbage, whatever you want to burn. Just burn it, as long as it's not from Russia. I think that is so. So I think it's going to be a very aggressive move away from Russian energy. How far they come by end of year remains to be seen, but it's going to be a significant reduction.
Yeah, and also back to the question about nuclear as well. Nuclear capacity for using Germany as a reference. We see that was planned to close already now at the end of year. So the December 2022 is the final deadline for closing nuclear capacity in Germany. And we have actually seen that the Germans are sticking with this so far. But it's of course will be interesting to follow. They have around 3-4 nuclear plants.
3 left.
3 left.
Yeah.
They have 3 plants up and running. So I believe that, throughout the summer, we see that there's higher prices for longer, etc. I think those plants are likely to continue operate for at least 2 to 3 years.
I think it's very, very hard to say what is going to happen with German nuclear power. I think all the political signals we see so far is that they will be closed this year.
Yeah.
Period. Because it's too tough political negotiations to take between the different factions of politics in Germany. But we see other places, like in the Netherlands, we see, or I think it was Belgium, basically it's asking for extension of life of their nuclear power plants beyond the planned shutdowns in, I think, 2025. And of course, France is already a big nuclear power producer, so is UK, and they are going to double down on their efforts. But of course, to go nuclear in a lot of countries in Europe where you don't have nuclear today is a very, very difficult thing. You don't have nuclear engineers, you don't have a positive public opinion, and then, you know, so, and it takes a very long time to build nuclear power. So I think first out, the most immediate is a massive boom in solar power installations in Europe. I think you're going to have, right? I mean, you used to have the CO2 price as the instrument of politician to punish everyone who didn't want to go green. Now politicians are instead going to say, here's the money, build the stuff, build it now. You know, so it's going to be a lot of support schemes, a lot of subsidies, because we need security of supply. We need to move away from Russian energy, and we need to do it now. So money on the table, willingness to do it is extremely high, and it's almost as energy is part of the defense budget, right? No longer, I mean, who cares about the stick? We just need the money to get it done, right? So I think first round is as a lot of acceleration in renewable energy, but also more plans, specific plans for nuclear, especially in France and the UK. Germany, I think it's still, any signals I've seen, they will be closed by end of year. Could change, but impossible to say.
Thank you. I think there was a later question related to the environment and climate change. I think I can comment on this as well as briefly you will say that it's unfortunate that we now need to sacrifice our ESG goals and the climate change ambitions for a reason that we want to secure energy security. And there was a question by our listener actually that to what extent the underinvestment in hydrocarbon-based energy sources has been a result of a general hostility towards the sector by climate change activists. So very briefly,
I think it's a very good point that you know, there has been an extremely strong political push towards fossil fuel producers. A lot of regulations on the taxonomy in general in the EU. With a lot of focus on the producers. So, I mean, we have all these negative forces towards the fossil fuel producers, but not at all the same kind of negative focus on the fossil fuel consumers. So the natural consequence is, of course, that producers say, oh, well, you hate us, fine, we'll not do it. And consumers say, well, I still like jet fuel, gasoline and diesel and buy a lot. And politicians say, fine, yeah, just consume it, right? And then you have this great imbalance. So I think, you know, this is very true. You have this green fear and this green aggression versus fossil fuel producers, which is kind of unbalanced. But nonetheless, I think, you know, is this change, is it bad for the environment? Yes, you're going to burn a lot more coal short term, but at the same time, you're going to accelerate the energy transition big time. You know, I mean, you're going to build solar and wind even faster, and you're going to accelerate sales of electric vehicles even faster. So yes, in the short term, emitting more CO2 because you burn whatever you burn, and no one cares right now. But towards 2030, I think the path of emissions in the EU will be lower. And of course, in terms of consumers of energy, I mean, they look at current very high fossil fuel prices, energy prices, and they say, this is the cost of renewable energy. This is the cost of fossil fuel. So let's build more renewable energy. So I think you have now extremely strong forces of economics alone without any subsidies to build solar and wind, because now it's hugely profitable, especially because fossil fuel prices are so high. And in addition, governments are saying, here's the money, build even more. Right? So I think it's going to accelerate the energy transition rather than anything else.
Yeah. Good, thank you. I mean, if to look at very isolated at this matter, I believe that it's, and I underline, isolated into the renewable energy boost. I think it's a good kick sort of to really boost the capacities of the renewables. But of course, the reason and let's say what is forcing this to boost is definitely not the most, let's say, positive ones. That's the war started. I move forward. I think you actually have answered to the question about how Europe can diversify energy supply and what we need to prepare for future in the winter season. I think you also have well covered actually about what can or which countries could physically replace Russian natural gas supply for Germany. That was specific slides given that. Please, colleagues, interrupt me if you think you want specifically something to add, because I want to move forward with the questions as we have a number of them still. A good question regarding for Europe, it will be very difficult to get diesel in order to replace Russia as a supplier, because of other possible suppliers in Middle East or India cannot provide sufficient volumes. Is it possible that there might be a real stress in diesel supply in Europe in April, May, if war continues or sanctions get stricter?
There is a real, I mean, we already have an ultra tight diesel market in Europe, and we have backwardation where the front month contract is like $35 per barrel higher than the month number 7 on the forward curve, basically explicitly saying that we are in big trouble with respect to the diesel market. And Europe normally imports something like 750,000 barrels per day of diesel from Russia, in addition to a lot of other oil products as well as a lot of crude oil as well. But so far, also looking at the global market for oil products, I mean, we had a terrible period for refineries in 2020 and 21 with very low consumption of middle distillates, very negative refinery margins for many refineries, and a lot of closures of refinery capacity around the world. And now with reviving demand, we suddenly already, before the invasion and troubles with Russia, Ukraine, we already had a very tight middle distillate market due to these refinery closures. And now, of course, we are losing additional refinery activity in Russia, and we're losing diesel supplies directly to Europe. So this is stressing even further the global balance for diesel products. And of course, it's most accentuated in Europe, where we normally get diesel directly from from Russia. So what happens now is that Russia exports Urals crude to India, and they export diesel products back to Europe. So, I mean, oil, crude, and products now suddenly start to make long journeys across the world to circumvent all the problems with Russia, and the buyer strike in Europe is leading to lots of additional friction, but first and foremost, a huge reduction of refining products out of Russia to Europe, but also to the global marketplace, leading the global market even further into a tightness of a situation for middle distillates.
Good. Thank you. There was a clarification question. We see that refining margins have sharply increased in recent weeks in Europe. Is it true, and does it mean that refineries will have a very strong Q1 in 2022 in terms of profitability?
Well, I think refineries, I think the improvements in refinery margins lately are very recent. And if you look throughout the first quarter, refining margins haven't been very good in Europe over this quarter. And one of the important parts is because natural gas has been so expensive, and it's used to make hydrogen, which again is used in refineries to desulfurize oil products, and also in crackers to close hydrocarbon chains. So you need a lot of hydrogen. It's very, very expensive. And it's really destroyed refining margins in Europe, even if it looks like the refining margins are good. They are not, because you need to subtract a lot of costs for the hydrogen. But lately, we're moving into positive territory. So I mean, earlier in Q1, we saw a lot of closures of hydrocrackers and upgraders in Europe due to the high natural gas costs. So I think it's too early to have a great quarter for refineries in Q1. So now it seems like the feed is frozen from your side. There it's going in. So any more questions?
Yes, thank you. Sorry, we have some network problems here around, so sorry for having some disturbances. But thank you for the answer, definitely, and we move forward. So let's move maybe to some alternative fuel types. And what is your prognosis for biofuel price tendency? And I would add from myself, volume tendencies or capex tendencies for the next years.
Well, I mean, a lot of the environmental regulations which are already in place will, of course, continue to be in place. So we see a lot of blending requirements into jet fuel for biojet, and that is, of course, going to increase year by year towards 2030. And also, in order to get more independence from fossil fuel imports, especially from Russia, but in general as well, I think there's going to be more political support for more production of biofuels as well. But of course, it's a problem if the biofuels are produced from food staples like soybeans and corn and wheat, because we now have a huge problem with exports of agriculture out of Ukraine, which is the 5th biggest grain exporter in the world, followed with Russia as number 1. So we're looking into a very, very stressed situation in global agriculture markets. So if you boost production of biofuels from food staples, it's going to be even more negative. So I think you have to look at biofuels made from wood in different ways, or also for electrofuels, and also for fuels converted from garbage and plastics rather than food staples.
Mm-hmm. Good, thank you. I think you also have well elaborated and covered the question about the future gas electricity prices, so I will skip this question. But there is another interesting one. In your opinion, what is the logic behind Russia's demand to pay for gas in rubles, and who will lose most in this regard, Europe or Russia?
I think it was a bit funny to listen to, and I think we still haven't moved away from Russian energy. I mean, we still import lots of oil, and maybe not oil, but lots of natural gas from Russia. And as such, Russia does indeed still in the short term have the upper hand. I mean, they are the supplier of energy that we still consume, and we haven't solved the technical problem of replacing it yet. So, I mean, Russia can indeed place the conditions of those sales. And I think as such, it's a display of their power position versus Western Europe still. They are the supplier of this critical energy that Europe hasn't been able to replace yet. And Russia can say, well, now you pay in rubles, right? So I think, I don't know how important it is, but it's a gesture of power position from Russia, I think, and maybe then Europe would be forced to buy rubles from Russian banks or the central Russian bank, and maybe to support the rubles, etc. But I haven't thought more about it.
No, I think it's also worth mentioning that most of these long-term contracts between Gazprom and the big consumers in Europe are usually pricing their gas in euros or dollars. So on long term, so demanding to be paid in rubles is sort of like a breach of contract. You know, it's not that straightforward. I think it will be yeah, but it was a fun play there. But
I mean, it doesn't really change a lot. It would force the buyers to first buy rubles with euros, giving euros to the central bank of Russia, rather than paying in euros and giving euros directly to the central bank of Russia. So I don't know how much it changed really.
Good, thank you. Our time is ticking out, but I still have, I think, at least a few very interesting questions. If you say that the price level of natural gas is 100 euro per megawatt hour, is what Europe is able to pay maximum at medium term, does it mean that approximately 200 euro per megawatt of wholesale electricity price is what at maximum we might expect in the medium term?
Yeah, I think that is probably true. I mean, we don't know. We don't know where the paying threshold for Europe is in terms of paying for energy. So it's more in terms of thinking along the lines of multiples of normals. I mean, 5 times normal. I mean, it's extremely expensive, but also in terms of historically where oil prices topped out and really hurt the economy back in 2008, close to $200 per barrel of oil. So you know, it's a proxy, and no one really knows. But I mean, we can look at this German SEB index, the forward-looking growth index. It's now at the lowest level since March 2020, at the peak of concerns over COVID-19. You know, so growth outlook by companies in Germany is very, very low. Optimism is very low because of these high energy prices. So I think already in the autumn we saw closures of industrial activity, of heavy industry, due to high energy costs. So I think this is taking a toll of the European economy already.
Good. Last one, maybe question very specific for Lithuania, as we have this LNG terminal, FSRU unit or ship, how you call it. And we pay approximately, at least by our dear listeners states, $69 million annually from 2014. I think for the sake of interest, it would be interesting to check or compare what could be the rates today for such a FSRU unit, which I guess is extremely high in demand now.
Yeah, I mean, of course, we've seen the global LNG shipping market going ballistic with the super high freight rates. They have come down as Europe started to take most of the flows from the US that normally went to Asia. They instead went to Europe. That brought down the freight rates. But, you know, I think it's still going to be a very strong market with very strong need for freight activity for LNG, with the cost of transportation still being quite high. What do you think of that question, Ole?
No, I'm not sure if I got it right. You mean the cost of the FSRU that's likely to go up in terms of rates, or?
Yeah, what is the current charter rate for FSRU unit?
Oh, I don't have that on top of my mind. I know that the rate has been falling quite sharply on the conventional LNG freights due to, of course, you have a less shorter distance between supply and demand, being US and Northeast Asia, and then US and Europe. So on the conventional side, rates has fallen quite rapidly. But on an FSRU, you usually have that's not directly transferred over to the conventional side, and you usually lease that for 15, 20, 25 years. So that's changed from FSRU to FSRU.
Yeah,
so I don't have that numbers on my mind. Sorry.
Yeah, correct. Most probably depends on many characteristics. Good, but what I hear is actually that the renewable energy will have a really big boost, and given that the long-term energy contracts, you showed that approximately, was it 70, 80? Yes, 5-7 years energy offtakes, something like that. So considering, I mean, the cost of building wind power plant or solar power plant, that's obviously a good opportunity, I guess, for the investors to expand if that's really sustainable to maintain at this level. Any comment?
Yeah, I think, I mean, the interesting thing, I mean, if you just look at the sort of the historical average price of power prices in Germany over the past 10-15 years is typically like 40 euros per megawatt hour, mostly just the short-term marginal cost because we've paid down the capex already. And then look at the average solar cost break even for solar in Germany, Portugal, and Spain in 2021. I mean, it came down to 36 euros per megawatt hour without any subsidies. So even below the very low historical spot prices we've had in Europe. And it's set to fall further, though, in the short term with some cost inflation. And then suddenly the new power price is going to be minimum like 80 euro per megawatt hour for the coming decade. I mean, it's like printing money to install solar. And I think every industrial company with area to build so they can have solar behind the meter, or residential consumers with super high utility bills, they will order solar power in big volumes in the coming years. Due to two things: very competitive cost versus current prices, also versus future prices, and you're also going to have strong support schemes from governments.
Good, yeah. Okay, with that, I would like to conclude this webinar session. And first of all, to thank our dear guests from SEB Group, dear Bjarne and dear Ola, having opportunity to join us and to share your valuable insights on the energy, oil and gas sectors. We found them absolutely very interesting and valuable. I guess, as I said before, I mean, we live in an extremely complex world with a lot of factors influencing these items, these raw materials, but I really enjoyed listening to you, how you provided a summarized and consolidated view in a very simple way. Really, thank you for that. I also thank our dear clients who have been with us today and listening and asking questions. I hope you found it as well interesting and valuable for you. We continue with such, we call it intelligent sharing, or our insights sharing with you, as we value the relationship and the feedback you provide to us after such sessions. So we'll continue that on some other topics. This was in particular, I think, extremely important and relevant, as we are evidencing historical fluctuations over the decades, I guess, on these items. And this is definitely, as our dear colleagues mentioned, a huge challenge, a disruptive challenge to accommodate in the cost sort of budgets and processes, and how much the economy can handle this enormous peaks of energy prices and raw materials. So really, I thank you for this session. We look forward to meeting you in some other ones as well. Invitations will follow. Wishing you all the best, and stay healthy and safe. Have a nice day. Thank you.